There are only two paths to minimizing investing mistakes. The first one is the expensive path, wherein you can make those mistakes yourself, call it experience, and come out of it a little or a lot poorer. And the second smarter way is to learn from others' mistakes. In this video, we examine 10 of the most common mistakes made by everyday investors and how you can prevent them. Think of this video as a checklist wherein you can take a hard look at your own investing practices, list out the mistakes you've been making, and then change your investing behavior and practices for the better. We often talk about keeping money aside for short-term goals and criticalities like paying off a loan, a child's school fees, or simply setting up an emergency fund. These are important personal finance elements, and one should not invest any of this money, especially in the equity markets. But perhaps a more lethal financial crime would be to invest money that you don't own. For instance, a personal loan is money that you don't own. After all, a loan is not an asset for you. And since you don't own the loan, it is not advisable to invest that money in the stock market. It is something most financial planners and even marquee investors like Warren Buffett would not want you to do. In the same thread, one should be careful about investing in futures and options, as there too a large part of your investment is leveraged, and time and again we see fortunes being lost due to unnecessary greed, like what happened recently with Bill Huang of Agios Capital, who lost over $20 billion in a matter of 10 days. So be smart with your money and avoid leverage for personal investments. For someone who is considered the world's best investor, it does seem odd when Warren Buffett endorses investing via a low-cost index fund. Perhaps he does that more to discourage people from chasing the latest hot industry or trend, which have time and again made a few people rich and a lot many people poor. When someone like Buffett or venture capitalists or fund managers invest, they put in hours and hours of research and often reject dozens of companies for every one they invest in. This sort of due diligence is the bare minimum expected from any investor to ensure your investments are worthwhile and that they stand a chance to make a healthy profit for you. The more due diligence you perform, the better your investing results will become. But if you cannot dedicate this time, then you are better off investing in professionally managed funds or a system-based index funds which are better equipped than investing oneself in an ill-prepared and ad hoc manner. Here's a question. If timing the market was such an important skill, then why is it not acknowledged by any of the top 100 investors in the world? Let me tell you why. They don't recognize market timing as a skill because probably it does not exist. And yet, a majority of investors in India and around the world continue to chase this imaginary line, assuming they know when the market peaks and when it bottoms out. Our studies here at ETMONEY show that more than timing the market, what has a larger bearing on your investing income and your investing wealth is the time you stay in the market. In fact, we put together a wonderful data-rich video on this a couple months back, and if you haven't watched it yet, then it's highly recommended. In that video, we explained a scenario where if you were the worst investor in the world and had only invested in those months when the Nifty 50 was at an all-time high, you would still, over 21 years, would have made a reasonable 12.3% annualized returns. So do watch that video, and if you're a long-term investor, then try not to develop a trader or a speculator's mentality. Many studies have concluded that asset allocation has a major bearing on portfolio returns, and yet this simple task is blatantly ignored by most investors. In fact, we too, in many of our videos, have stressed upon the importance of asset allocation and even have a popular video on this, where we establish with actual data that a balanced investor who puts part of his money in debt, gold, and equities can make as much returns as someone who does not asset allocate but puts 100% of his money in a single asset class. Of course, the kicker here was that this balanced investor achieved the same returns as a Nifty 50 investor, but consumed a lot less portfolio risk in the process. So remember, a lot like how it is important to get your team composition right with attackers, midfielders and defenders, the right composition of asset classes too will go a long way in ensuring you achieve the most optimum risk-adjusted returns. Diversification happens when you add an asset to your portfolio, but more importantly, this asset you add should have a different risk profile to what the portfolio currently has. For example, say you have a portfolio which mainly consists of large caps, so blue chip stocks and large cap mutual funds. Now, to diversify this portfolio, you might want to introduce non-related asset classes like gold, real estate, bonds, commodities, etc., which exhibit a low or inverse correlation to large caps. However, many investors end up diversifying their portfolio by adding more assets with a similar risk profile. For instance, they might add mid-cap funds to a large cap portfolio, which really does not solve anything as the performance of mid-cap funds is not very diverse from that of large caps. In fact, one might end up aggravating the problem even further by lopsiding your portfolio's risk profile. So that's one mistake that you should avoid making. Impatience is often termed as the most costly emotion within investing and comes from having unrealistic timelines. For instance, stocks are nothing but a representation of a business, and every business needs adequate time to build strategies, start production, setting up distribution systems, collecting revenue, and a lot more, all of which takes anywhere from a few months to a few years. However, investors expect that the shares they recently bought to move in the expected direction almost immediately, which almost never happens. And it's this mismatch of expectations that pushes these short-term investors to sell before reaping the advantages of the business's growth. In fact, patience has been one common trait amongst most of the world's greatest investors who have all held their undervalued shares for many years and have been rewarded for their patience many times over. So remember, a steady and calculative approach with a realistic time frame will yield you greater returns in the long run. A common practice amongst everyday investors is to chase historical performance by investing in mutual funds which have done well in the past 1 or 2 years. However, time and again we have seen that funds which are ranked in the top quartile find it very difficult to replicate the performance in the subsequent year. But having said this, millions of investors still opt for past top performers, which mostly ends up as a mistake. In fact, this concept extends to averaging as well. For instance, the Nifty 50 TRI has delivered an average of 13.9% returns in the last 20 years. So one might say, you know what, I'll invest my money in the Nifty 50 and I'll probably get between 12 and 16% every year. But then what the data shows is that in only 4 out of the last 20 years, the returns were between this 12 and 16% mark. And in all the other years, there were massive variations with the Nifty 50 performance ranging from plus 79% to minus 50%. Simply said, past returns is no barometer for future performance expectations, and it would be in an investor's interest to put very low weightage to that piece of history. There is a very old saying, a rising tide lifts all boats. In that context, a bull market always pushes up some undeserving stocks, and that's purely because these lucky stocks happen to be at the right place and the right time. A number of these freeloaders might be heavy in debt, would probably have negative growth, might have pending litigation, poor management, but nevertheless they just got lucky. And if you too got lucky to have had them, that does not make you a brilliant stock picker. So in reality, there are 2 real measures of one's investing skills. One, the value added returns, that is, how much more your portfolio performed when compared to a benchmark. This means just because your portfolio gained 50% does not make you a stock guru when the stock market in general has gained by 70%. And point 2 is, what were your investment results over an entire stock market cycle? Now, this phrase stock market cycle can mean different things to different people, but internally we believe it means a time period that encompasses 2 bull markets and 1 bear market. In other words, this is a pretty long cycle of 10 to 15 years and not some smallish period of 1 to 2 years. Here's an important rule. Everybody has a conflict of interest with your wealth except you. After all, banks manage your money so that they can charge fees. Financial advisors earn a commission, stockbrokers make profits on every trade you make, and so-called stock market experts want you to buy their subscription packages. And while it's true that there are some well-intentioned and honest people doing their absolute best in this field, it still does not justify you putting your blind trust in them. Because for every good piece of information that may be to your benefit, there is likely to be dozens of poor pieces of guidance which are likely to hurt you financially. So the next time you're exposed to some expert information, stay curious but also stay skeptical enough so that you yourself research everything you receive, including this YouTube video. Remember, no one is more responsible for your financial well-being more than you. The objective of investing is to maximize profits for any level of risk, with taxes being only one component to that equation. But a mistake that's made often is to be very inflexible about the implication of taxes. For instance, many investors never sell their investments as they don't feel like paying taxes, or prefer to pay lower taxes for which they will continue to hold on to securities much after those stocks or mutual funds have served their purpose and have reached the adequate returns. Net, consider tax as one of the many factors in analyzing a transaction and not the only factor. Of course, the reverse is also true, that is, don't completely ignore the tax consequences on your investments. And with this, we conclude the 10 most common investing mistakes made by investors. I think it was Albert Einstein who once said, insanity is doing the same thing over and over and expecting a different result. Mistakes are a part of the investing process, and knowing what they are, when you are committing them, and how to avoid them will help you succeed as an investor. The 10 investing mistakes listed in this video are not the only ones, so if you remember some others that you have made, then do add them to the comments box below. If you like this presentation, then do subscribe to the ETMONEY YouTube channel and help us spread the good word by sharing it over WhatsApp, Facebook and Twitter with your friends and connections. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.